Welcome back to Investing Talk Podcast.
Today we're looking at Broadcom.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis. We're talking about a company that has, fundamentally shifted. It's not just a chip supplier anymore. It's really become the indispensable infrastructure player in this whole global AI race.
Right, and you can see the market is finally waking up to that. We've seen just phenomenal momentum around these infrastructure companies, and Broadcom is right at the center of it all, especially when you look at the raw numbers from their last quarter.
Absolutely. The Q1 results for their fiscal 2025, they paint a very clear picture. Revenue hit $10.92 billion. That's a massive 36% jump year over year.
36%.
But for me, the most telling figure, the one that speaks to their, competitive position, is the margin expansion.
The 50.9% operating margin, that's what caught my eye. It's up from 47.5% the year before, that's a record high for them, right?
It is. And that kind of growth, at their scale, a multi-hundred-billion-dollar company, It's just extremely rare. It screams pricing power.
Yeah, you don't see that every day.
No, you don't. And it looks like the analyst community is drinking the same Kool-Aid. The estimates for their full-year earnings, they've been raised 8 times in the last 90 days.
8 times?
Yeah, pushing the consensus from around $47 up to over $50. And that frequency of positive revisions, that's one of the strongest validation signals you can get in tech right now.
And if we dig into where that's coming from, it's all about AI. It has to be.
It's all AI.
The semiconductor part of the business grew 44% to almost $8 billion. But here's the number, the nugget that really matters for the long-term story. Volume.
Give us the number.
Broadcom shipped about 20 million AI-related custom ASICs. These are the application-specific integrated circuits in Q1 alone.
Wow.
That is a 120% year-over-year jump in volume for these chips. These are the absolute backbone of AI data centers, including the stuff they co-designed with NVIDIA. They are leading the charge in just sheer volume.
And that AI demand, it gives you the acceleration, the speed, the headline growth. But the foundation, the thing that lets investors sort of sleep well at night, that comes from their software segment.
Stability engine.
Exactly. Infrastructure software brought in $2.93 billion, and that grew a very healthy 19%. And this software is incredibly sticky.
How sticky are we talking?
The net dollar retention rate is at 114%. So customers aren't just staying, they're spending more, they're expanding. It provides this consistent, high-margin, recurring revenue that critically, it buffers any of the ups and downs you might see in hardware spending.
Okay, so let's pivot from the income statement to the balance sheet. Because this company isn't just making sales, it's generating serious cash. They ended Q1 with what, almost $12 billion in cash?
$11.8 billion in cash and equivalents, yeah. And they're actively paying down debt, which is down to $78.7 billion.
And that leverage ratio, that's what really stands out. Their net debt to EBITDA is like 1.8x.
Which is incredibly low. To really get why that's so impressive, you have to look at their competitors. The average for their peer group is closer to 3.5x. So this isn't a company that's straining, it's a financial fortress.
A fortress that prints cash.
Yeah.
Which brings me to the free cash flow. This, I think, was the most staggering number of all. $5.92 billion in FCF in a single quarter, a 51% increase year over year.
A 51% increase, and that results in an FCF margin of 54.2%. That is just, it's world-class. It's among the highest globally for any large-cap tech firm.
In any sector.
Any sector. When you see a huge infrastructure company printing cash like that, it suggests they have basically zero competition on price. They're generating cash like a pure software monopoly, but they sell hardware. That, for me, is the real story here.
And they're putting that cash to good use for shareholders. They do pay a dividend, but the real story is the buybacks.
Heavily is an understatement. They bought back $5.1 billion worth of their own stock in one quarter.
That's insane. That's 3.7% of their entire market cap. Gone in 3 months.
And that consistent large-scale buyback just keeps that earnings per share engine turning.
Okay, so this brings us right to the competitive moat. This is the heart of it all. Why is this company so indispensable? Why can't, a huge customer just wake up and say, we're switching to someone cheaper?
It's 2 things. Vertical integration and almost insurmountable switching costs. They own the full stack. We call it the plumbing of the AI data center.
Plumbing, right.
They don't just sell you one chip. They control the custom ASICs, the ultra-high-performance Tomahawk switches, all the Ethernet and PCIe controllers, the RF chips, and then they layer their management software right on top of it all.
Let's unpack that a bit. What does a Tomahawk switch actually mean for someone listening? Why is controlling that one piece so important?
Okay, so if the ASICs are the brain cells doing the work, the Tomahawk switch is the high-speed spinal cord. It controls all the traffic, the entire networking fabric between every single AI chip in that data center. By owning that, Broadcom dictates the speed, the efficiency, the very architecture of the whole AI cluster.
So because of that integration, the big cloud customers, Meta, Microsoft, Amazon, they have to design their entire multi-billion-dollar AI systems around Broadcom stack. And if they wanted to switch,
It's not just hard, it would be financially catastrophic. You're talking about an 18 to 24-month re-architecture project, tearing out hardware, rewriting tons of code. You just don't change the plumbing while you're building the house.
so they're structurally embedded.
Deeply. And their IT, their intellectual property, reinforces that moat. We're talking over 34,000 patents. And these aren't just any patents. They are foundational patents for next-gen standards. PCIe 6.0, CXL 3.0, 400 gig, and 800 gig Ethernet.
Which are the languages the next generation of chips have to speak.
Exactly. They are the required communication standards for the next decade of AI. By holding the core IP, they make sure all future builds have to flow through their hardware. It protects them from anyone trying to copy their architecture.
Okay, so switching gears a bit to market momentum. The technical picture looks incredibly bullish. It seems to confirm everything we've just laid out.
The price action is textbook. The stock broke above a really key resistance level, 1520, back in April, and it did it on huge volume. That's a clean breakout from what chart watchers call an ascending triangle pattern, a very strong continuation signal.
And the longer-term signals are there too. We saw that golden cross, the 50-day moving average crossing above the 200-day that happened back in March.
Which is a huge shift in long-term sentiment for a company this size. It's the first time we've seen that signal since 2021.
Plus, you can see the big money is moving in. It's been trading above its volume-weighted average price for, 41 straight sessions now?
41, yeah. And that's a rock-solid signal that sophisticated institutional money is buying and holding for the long run. They believe in this multi-year story.
And that confidence ties right into the corporate news. They announced that new custom AI chip, the CAI 800.
Right, the one specifically for Microsoft Azure's next-gen clusters. And production is set to ramp in Q3, which means you have guaranteed revenue visibility from one of the biggest cloud spenders on the planet.
And they also just closed that Velis Technologies acquisition, $6.1 billion.
And that's a really strategic one. It's not about buying more hardware, it's about software. It enhances their generative AI model optimization stack. It's a move to get even deeper into the high-margin software world, reinforcing that stability engine we talked about.
If you want confirmation from the inside, the CFO bought 5,000 shares back in March, a $7.2 million purchase.
The largest insider buy since 2020. You couple that with a net institutional inflow of $3.2 billion since January, and the sentiment is just overwhelmingly constructive.
So looking ahead, we have a pretty clear calendar of catalysts coming up.
Yeah.
The next 3 months look busy.
Very busy. The immediate focus is Q2 earnings on May 1st. The street's expecting another beat, but the market will be laser-focused on guidance. What are they saying about AI chip demand and data center shipment volumes?
But for a long-term story, the bigger date is May 15th, the Investor Day.
That's the big one. That's where they're expected to unveil their official AI ASIC roadmap all the way out to 2028. That kind of long-term guidance is crucial. It confirms that this demand isn't just some flash in the pan.
And then in June, there's the OFC conference.
Right, where they're expected to demo an industry first, the 1.6 terabit Ethernet switching chip. If they pull that off, it just further cements their lead. It'll have competitors scrambling just to catch up.
And then there are the macro tailwinds. If the Fed signals a rate cut in June,
Then capital-intensive tech stocks with high free cash flow like Broadcom, they have historically outperformed significantly in the year or so after that first cut.
we're also hearing some speculative chatter, right? Rumors about a big deal with an auto OEM.
Yeah, a potential $2 billion deal for vehicle-to-cloud ASICs, that would open up a whole new high-value market. And there's talk about them exploring in-house memory packaging to reduce their dependency on outside suppliers, more vertical control.
Of course, we have to look at the other side, the bear case.
Yeah.
And the main risk here seems obvious: customer concentration.
It is. 42% of their revenue comes from just 5 customers: Microsoft, Amazon, NVIDIA, Meta, and Google.
So that makes them pretty vulnerable. If one of those hyperscalers just taps the brakes on spending, it's going to hurt.
It immediately hits the top line, for sure. If Microsoft delays a big data center build, you'll see it in Broadcom's numbers that quarter.
Wait, hold on. 42% of revenue from 5 customers. But you said earlier that 75% of the company's EBITDA, the profit, comes from that sticky software. So if Microsoft slows hardware spending, doesn't that software buffer still leave them exposed to a major headline shock? How deep does that buffer really go?
That's a fair challenge. The buffer doesn't prevent a revenue shock. It prevents a profitability shock. The hardware revenue is cyclical, it's high volume, but the software is high margin and recurring. So the software provides the vast majority of the profit.
75%.
Right. So even if capital spending slows down, that stable, recurring profit engine keeps running. It keeps that massive cash flow machine intact.
Oh, okay. So it stabilizes the bottom line even if the top line gets choppy.
Exactly. And while, regulatory scrutiny is always a risk for a company that does big M&A, the fact that their recent deals got through the FTC without issues, that sets a pretty favorable precedent.
So when you wrap all that up, the risks included, where did that leave the valuation?
Well, it trades at about 29 times forward earnings, which is actually a 12% discount to some of its peers that have, frankly, lower cash flow margins and higher debt.
So you have a company with world-class cash flow, this unassailable moat, and guaranteed revenue visibility for years. And the market is giving you a 12% off coupon compared to its rivals.
It suggests there's a real misunderstanding of just how safe that software segment makes the whole business, and how truly indispensable their tech is.
The core thesis really seems to hold up then. You have this indispensable supplier for the entire AI build-out, a fortress balance sheet, and a ton of near-term catalysts coming up.
It's a powerful combination.
What's fascinating to me is that by providing that critical plumbing, the networking, the custom chips Broadcom, basically ensures that even if the AI software world changes completely, they still control the physical architecture where it all happens. They own the foundation.
A truly powerful position in the AI economy. If you want to keep up with the companies building the future, make sure you subscribe.